Hello guys, welcome back to my YouTube channel. To my returning subscribers, thank you so much for your support. I don't take it for granted. To my new subscribers, I am Sam G. I'm your lifestyle and personal finance guy, and I hope you enjoyed this video. Please leave a like, comment, subscribe, and turn on the notification bell so whenever I do post a video, you get updates. So today's video is one part of a two-part series that goes into detail on what student loans are and how to apply for some, and also some red flags to look for when you're shopping around for a student loan bank vendor like Sallie Mae, whether it's federal, whether it's private. Just some things to look for, but this video is more so an information on what they are and how they work. I'll be making other videos that talk about how to apply for them and what to look for when you're trying to find a student loan to apply to. So please leave a like, comment, subscribe if you enjoy the content, and without further ado, let's get right to today's video. Student loans are a type of installment loan that pay for college and its related expenses. This can include tuition, room and board, as well as other expenses like books, whatever have you that's related to college. Student loans are used to pay for that. There are two types of student loans, private and federal. This is important to note because the type of loan that you receive will dictate what your consumer protections are, what your repayment plan is, and what your interest rates are going to be. Federal loans are loans that are issued by the U.S. government. It's always a good idea to take out federal loans first before taking out private loans, because federal loans are usually less expensive with lower interest rates. There are many types of federal loans, but the first one I want to talk about is called a direct subsidized loan. Subsidized Stafford loans are available to undergraduate students who have demonstrated financial need. The good thing about a direct subsidized loan is that you won't have to pay the interest on the amount you borrowed if you're enrolled in college for at least half of the time or for 6 months after you've graduated. So that's something that's very important, and that's very beneficial when you look at repayment plans and the grace period that you have to pay back your loans. And again, this can be a huge cost savings when you start to look at how much interest compounds over the years that you're in college, as well as your grace period till you start paying them back. And even in the repayment period, interest is still compounding. So if you don't have any scenarios where you don't have to pay interest on the amount you borrowed, it's very beneficial to you as the loan receiver. The next type of federal loan I want to talk about is a direct unsubsidized loan. Now, the main difference between a direct subsidized loan and a direct unsubsidized loan is that unsubsidized Stafford loans are available to both undergrad and graduate students regardless of financial need. And another way that direct unsubsidized loans are different from direct subsidized loans is that you will need to pay the interest that has accrued on the loan in the time period that you have it, or the interest is pretty much going to be added to the loan balance as you're paying it off. So it's not interest free, because it's regardless of financial need. It just becomes like a standard loan where you have to pay interest on it. And even as it compounds month to month, interest is building up whether you're paying it or not. So you have to keep that in mind before taking out a loan. So my best recommendation, take out a direct subsidized loan. If that's not enough, look into taking out minimal direct unsubsidized loans, and I think that'll go far to help you in your college career. There's also the Federal Direct Plus loan. Grad Plus and Parent Plus loans are available to both graduate students and also the parents of dependent undergraduate students. Plus loans are not subsidized, so interest will start accruing the moment that the loan has been fully disbursed to the receiver. Repayment can be deferred while the student is still in college, and also up to 6 months after graduation. The final type of federal loan that I want to discuss is called the Federal Direct Consolidation Loan. Consolidation loans allow you to combine multiple federal student loans without losing the benefits of the student loans that you had. The consolidation method can be used to streamline repayment or switch loan services. Now let's talk about private student loans. These loans are available through banks, credit unions, and online bankers. While federal student loans might come with fixed interest rates as well as maximum amounts that you could borrow, the same cannot be said for a private student loan. Private lenders tend to set their own requirements for borrowing money, but typically if you have a good credit score of 670 or higher, that can get you some competitive rates and terms. One pitfall of this is that it makes it difficult for undergraduate students to borrow money through private lenders because they tend to have shorter credit histories, so they're not going to have a stellar credit score at the time that they're trying to go to college. Therefore, they would have to have a cosigner co-sign the loan for them before they can receive it. But there are some cases where you don't necessarily need a cosigner. So there are some undergraduate students that would not necessarily need a cosigner in some cases. Another important thing to mention is that private student loans do not come with borrower protections that the federal student loans tend to come with. So that's important to know when you're taking out a private loan. Private loan borrowers do not get access to income-driven repayment plans as well as any borrower protections. So it's important to always make sure you max out your federal student loan options before you start looking at private loans. This is very important. Next, I'm going to talk a little bit about how student loan interest works. In simple terms, student loan interest is a fee that the lender charges you to borrow money, and it's usually expressed as a percentage of how much you originally borrowed. Student loans can come with fixed interest rates, which means that the interest rates are not going to change over the life of the loan, or they can come with variable interest, which means that depending on the economic conditions, it can change. For most student loans, interest begins compounding as soon as you receive the money. This means that the loan that you took out during your freshman year will begin compounding interest, and if you do not pay any amount off of the loan while you're in school, by the time that you graduate, the balance that you have is going to be much larger than the balance that you originally got from the private student loan lender or whatever it's you got it from. The exception to this rule is obviously federal subsidized loans. As I mentioned earlier, while you're in school, the government is going to pay the interest, or if you defer your loans for any reason, the government is also going to pay the interest during that time as well. Now for the final part of this video, I'm going to be discussing student loan payments. And speaking of student loan payments, check out my other video on how I paid off my student loans in less than a year. I think it will be really helpful if you're looking to pay off your student loans or you're in the grace period where you're preparing to pay off your student loans. When you first make a student loan payment, the payment is applied to the interest that you have on the loan, and then the remainder is applied towards the principal, which is the balance actually owed on the loan. Therefore, when you start paying your loans back, a large portion of the repayment is going to be eaten up by interest charges. So it's important to pay more than the minimum payment if you can, as much of the minimum payment. If you can pay maybe plus $100 on top of it, or if the interest every month is $150, pay $150 on top of the minimum payment. I think that is going to really help you. An important thing to note is that interest on your loan accrues daily, right? And at a certain point, the interest that accrues becomes part of the loan balance that you have. This is called interest capitalization. It becomes part of the loan balance that you have. Now, obviously, if interest is now added to the balance, interest is going to be accrued on both the balance and the interest. So interest is going to be accrued on the existing interest. The period in which interest becomes capitalized really depends on the exact loan that you got originally, but it often happens when you enter into a repayment plan or a temporary forbearance. Thank you guys so much for tuning in. That's it for today's video. If you have any topics, please drop it in the comment section. I'll be more than happy to tackle it. Again, if you enjoyed this video, please leave a like, comment, subscribe, turn on your notification bell, and just share this video to as many people as you can. Share the channel to everyone. Really helps me out a lot. I really appreciate you guys' support, and I look forward to making more videos for you guys. Take care. I'll catch you guys in the next video. Peace out.